Under One Roof MTL, hosted by Robin Flynn, featuring mortgage brokers Fred and Martin and real estate expert LJ Aguinaga. Presented by Fred and Martin Mortgages and LJ Realties.
Good afternoon. It's 12:05 and this is Under One Roof MTL on CJAD 800. This is the show where we are demystifying home ownership 1 week at a time. I'm Robin Flynn, joined in studio as always by LJ Aguinaga of LJ Realties. How's it going, LJ?
It's going great. How are you doing?
Very well, thank you. I have to say you look very dapper today. Stripes are definitely your thing.
Thank you so much. Appreciate the compliment.
Is that how the show is going to go today?
Martin Spalding from Fred and Martin Mortgages. How's it going, Martin?
Oh, I think Robin is blushing.
Somebody's getting a little bit jealous in the corner over here.
I really like those glasses. Those are nice frames on you.
Oh, it's not going to happen. I'm going to wear stripes next week.
There you go. We are with you until 1 p.m. We have a lot to get to today. We'll start with our trivia question of the week. Why don't we? Because we're coming in off the trivia show. Everybody is primed and ready to answer a trivia question. This one is brought to you by Felix and Norton Cookies. You can visit their store at the Blue Haven Shopping Center, 3705 St. John's Boulevard in DDO. If you are the first person to text in the correct response to 514-790-0800, you'll receive delicious cookies from Felix and Norton delivered straight to your door. Our question this week, in Quebec, what is the standard time frame for a buyer to fulfill all conditions after an accepted offer on a property?
Is there a precise answer to that question?
What is the standard time frame?
Okay, because I'm looking at LJ right now.
His eyebrows are raised.
What's the jury going to accept?
You know what? We're going to have a conversation about this in a second. We're going to revert back to what I use as standard.
All right.
Okay.
What does LJ's team use as standard?
So it's LJ standard.
LJ's standard.
Okay.
Perfect. If you think you know it, 514-790-0800. Text in the answer to us. Guys, let's chat a little bit about what's in the news this week. Variable rates are falling. Obviously, last week we talked about the Bank of Canada interest rate announcement, but fixed rates aren't coming down as quickly as variable rates are. Is that what you're seeing, Martin?
It's actually funny because you know what? About six weeks ago, we were seeing some better fixed rates than we're seeing today. So it's kind of counterintuitive because a lot of people think, the Bank of Canada is going down, everything's going to go down. And we've mentioned this time and time again, when the bank rate goes down, variable rates are directly affected by the bank rate. But fixed rates are more influenced by the bond market. And so the bond market, the traders, the analysts had actually already baked in the 50 basis points that we saw on October 23rd. So steady as she goes for fixed rates. So a lot of our clients are actually calling us up and going, well, you quoted me this, you quoted me that. Should I go variable? We're getting a lot of questions right now. And I think a lot of people who are actually about to sign for a fixed rate are a little bit kind of disappointed. They were expecting a windfall, and it's steady as she goes right now.
But that's the advantage of a fixed rate, is that it's steady as she goes,
yeah,
right?
But
are you speaking from experience, Robin?
Exactly.
As someone who's had a variable rate for the last few years, it has not been steady. It's been nice the last couple of months, but before that, not so much.
But it's actually really funny because a lot of our clients, when they call us, both Fred and I get on the call, and Fred has always been variable, and I've always been fixed. My father was a Scottish accountant, so by nature, my father was a very conservative man, and hence his children are very conservative. So I've always had fixed rate mortgages. But Fred, who's always been an entrepreneur, is a little bit more of a risk taker, and he's a little less risk adverse than I am. And so he's always been the variable guy. So if you look over the last 15, 20, 25 years, it's actually been advantageous to have a variable rate by up to 100 basis points over the length of your mortgage. But if you're the type of person that wants to know exactly what it's going to cost you on a month-to-month basis so you can budget appropriately, and I'm going to ask you a question in about a second, then you should go fixed. So, knowing that Robin, who has expressed the fact that she's been a variable rate mortgage holder for the last couple of years, how has that impacted your budgeting, your household budget? That, through COVID, we saw rock bottom rates, and then boom, the Bank of Canada started to increase, hence your variable rate went up.
It has made me a better saver because
Okay.
I don't know what's going to happen with the mortgage rates. So I make sure at the end of the month, when normally I would have money left over and we would do something fun with it, I've been putting it aside just in case rates were to go back up, that we would have savings to dip into. So I do think it has made me a smarter household manager, if you will. I'm better at budgeting because of it, because I had no choice, right? Your income isn't changing every month. Well, at least ideally it's not, but
Or it's increasing for you every month. You're signing new clients left, right, and center right now. So
exactly.
It's been good.
But that's another thing that comes with risk, right? When you're an entrepreneur and you're taking on a client-based, service-based industry, your income fluctuates. So
100%.
you can't have a good month and then live like that's going to be your income every month, as you well know, LJ.
Of course, of course.
Yeah, I made 25 grand last month. That's my new threshold.
Yeah,
Doesn't
not
work
so
that-
much.
It doesn't work that
You know
way.
what it makes me think, though? You said that Fred is team variable. You tend to be more team fixed. That's what makes you guys such a great team, honestly, is that you're really getting both sides of the coin.
Oh, sometimes it gets a little goofy because, we're sitting there going, because what the client wants is advice, right?
Yes.
And so it's not up to us to take the decision for the client. It's up to us to inform the client so he can take the proper decision that suits him or her best. So I will pitch, fix, conservative, you know exactly where you're going. Rates are good. And actually, fixed rates are better than variable rates right now. And then Fred will come in and go, well, in December,
gonna
it
come
could be
down
another
again.
50 basis points. And by midsummer 2025, we can see variable and fixed being almost at the same place. So if you're willing to gamble short term,
Yep.
you may be a winner long term. But the decision belongs to you.
And look at those penalties. Read the fine print, because if you eventually want to convert to a fixed when rates come down significantly, you want to know what those penalties are, right?
So if you're on the variable and you want to lock it into a fixed at that point, most banks will let you do that without any penalties if you stay with the same bank and don't change amortization, et cetera, et cetera.
Cool.
But it's only if you go from fixed to variable, that's when it's going to be a full break, and that's when they're going to hit you real good.
Okay, good to know.
That's a great piece of advice. And that's what we actually tell our clients as well, is that maybe, for the next 12 months, stay variable. And then at no cost, you can lock in whatever your sweet spot is. And if your sweet spot is, in the mid to high threes, because that's what we're projecting it's going to go, then lock in there. And you can lock in 3 to 5. And the other game that people are playing, and it's not a game because it tends to be, your principal residence tends to be the largest investment you'll ever make in your life. So you can't look at it as a game. But the rates right now are a bit of a game. So you got to game what's going on.
Exactly.
And so some people are looking at short term, so being fixed, but for 2 to 3 years, but the banks see you coming. Because if you lock in for 2 to 3, you're going to pay a lot more than if you're locking in for 5.
Right.
So the best way to do it is you run all the scenarios, you crunch all the numbers, and the numbers will talk to you. And if you see a number that you're most comfortable with, whether you're risk or risk adverse, then you lock in whatever makes you feel comfortable.
Because that's ultimately what is most important, right? If you're barely able to pay your bills every month, variable may not be a great option for you.
And well, it's funny that you bring that up, because we often see some of our clients that just muster up enough for the down payment and they're stretching themselves.
Yep.
They qualify, but they're stretching themselves. And they really tap themselves out in terms of their RSPs or wherever they're getting the money from. And then all of a sudden they move into a home and then they realize, wow, I didn't have a lawnmower. Do I need a lawnmower? Because now I got to cut the grass. Do I need a snowblower? And I don't have the money for a lawnmower or a snowblower. I didn't have an ironing board when I lived in an apartment. Now I need an ironing board. And if you completely tap yourself out, the joy of buying a new house, if you can't fix it up the way you want to fix it up, then there's a little less joy.
There's a term for that, right, LJ? House poor. That's what we call
Exactly.
people who have a lovely home and it's empty. You got nothing in it. You can't afford snow removal. That's a luxury. Our first year in our home, we shoveled our driveway ourselves before we bought a tempo, because that's expensive too. Before we paid for snow removal, that first year was a little difficult, but
Did
we
you say
learned a lot.
Never again after that?
Yes, shoveling snow. I'm fine to shovel my walkway, my steps. I don't pay someone to do that, but a whole driveway? No, thank you.
Especially at 5:30 if you have to be at work at 6 and all of a sudden you see
Mercy Bridge is backed up.
Or
Yeah.
the Mercy Bridge, no, but or the city truck has kindly put a huge snowbank at the end of your driveway. So it's not only clearing out your driveway, but digging through the snowbank that the snorkeling service has kindly left at the end of your driveway.
Fun fact. So I know we have to get to traffic soon, but that first year where we were shoveling ourselves, my husband and I out there with our shovels, all our neighbors had snow removal. So we were watching, the déneigement tractors come, and it was like 2 scoops and their driveway was done. It took under 5 minutes. And one of the déneigement companies came over, told us to get out of the way, gave me the little shh, and he cleared our driveway for us. I took note of which company it was, and that is who we pay for our snow removal now.
You know why they did that?
To get me to pay for snow removal.
No, because you're Robin Flynn.
Nice twist.
That is Martin. That's LJ. I'm Robin. You're listening to Under One Roof MTL on CJAD 800. If you're curious what sort of rate you might qualify for,
Under One Roof MTL, hosted by Robin Flynn, featuring mortgage brokers Fred and Martin and real estate expert LJ Aguinaga. Presented by Fred and Martin Mortgages and LJ Realties. This is the Mortgage Minute.
Mortgage penalties. What are they, and how can they impact you? This is your Mortgage Minute. Prepayment penalties are generally calculated based on the type of mortgage you hold. For variable rate mortgages, the prepayment penalty is typically 3 months' worth of interest on the remaining principal. This is straightforward across most lenders. For fixed rate mortgages, the penalty can be higher as it's calculated using either a 3-month interest charge or the interest rate differential, whichever is greater. Knowing these penalty structures is crucial, especially since unexpected life events lead over 65% of Canadians to break their mortgages early. Understanding potential penalties helps borrowers make more informed mortgage decisions.
this is Under One Roof MTL on CJD 800. I'm Robin. That's Martin. That is LJ. We're with you until 1 p.m. Breaking your mortgage. Guys, when I signed my mortgage, I didn't even know what that meant. I didn't know that was an option. Nobody ever explained it to me.
Well, obviously, you weren't working with a mortgage broker because it's our responsibility to explain to you before you sign for a mortgage.
All we cared about was what interest rate did we qualify and do we qualify?
Oh, I've got the quote right under hand. What does Fred always say? What does Fred always say?
Read the fine print.
No, he always said it's not just about rate. The
Yep.
conditions are just as important. And we know that Fred is listening. Hey-o.
It's true. Now I know all these things because doing this show with you guys has been amazing for me because I am learning so much. But breaking your mortgage can come with stiff penalties, and it happens more often than you might think. Things change. You sell your house. You get divorced. You have kids. Your parent gets sick and has to move in with you. A million things can happen. And sometimes those penalties can be really stiff. Is there anything you can do to lessen those penalties?
Well, let's go back a little bit. So a lot of people now are looking at interest rates go down.
Yes.
And so it's not a life event that is forcing them to want to break their mortgages. They just want to take advantage of the lower rates. And why do I bring this up is because there are two basically penalty calculations that go into calculating what the penalty will be should you decide to break your mortgage before the end of its term. So what does that actually mean? If you had signed for 5 years and you decide after 2 years that you want out or you want to exit from your contract with your lender, in reality, that is breaking your mortgage. So if you had a variable rate mortgage, as mentioned in the Mortgage Minute, you'll probably pay 3 months of interest. But if you had a fixed rate, what happens is now you're going to be confronted with the higher of the two. So the lender will say 3 months of interest or the interest rate differential. And how is that calculated? Well, I had to write that down because that calculation is a little bit it's a little bit complex. So I'm just looking at my notes. So the IRD is
Interest rate differential.
Exactly. I'm trying to sound hip like all the young kids. So interest rate differential. The IRD is calculated by taking the difference in interest you'd pay over your remaining term between your current contracted rate and the new rate offered in the market. if there's a sizable drop in rates between when a homeowner signed the mortgage and when they are considering breaking it, the penalty is going to be a lot larger, particularly if there are many years left being before renewal. There are a number of calculators online that you can actually go and try to figure out what your penalty is going to be, or you can actually ask your lender.
Okay.
So how do you mitigate potential penalties if you decide to break your mortgage? Well, how much time is there left on your mortgage? So when you're doing your calculations, let's say you only have 12 months left, then write it out. Because at the end of the term, you won't pay a penalty if you decide to go elsewhere or if you decide to renew under different circumstances, on different terms. If you think when you're going into a mortgage that you may need to break it sooner than later, then you can get what's called an open mortgage. And the open mortgage allows you to prepay and it basically allows you to do anything that you want. But the interest rate's a little bit higher.
Yeah.
You can port your mortgage, which is basically taking the current mortgage that you have and porting it or bringing it to the new property. But that comes with a certain amount of rules and regulations attached to it. In other words, you have to keep the same rate, the same amount, and it has to be for the same length of time.
But I'd say that let's stay on ports for a second,
Sure.
because I think that's a super interesting tool that a lot of our clients have used, especially when we see rates come down significantly or when a client has an awesome rate that they don't want to give up. When somebody is buying not because of, let's say, an unfortunate life event, but because they're actually looking to upgrade their home and they need a bigger property, or they've been moved jobs and they want to sell where they're at to go closer to their new job or school, anything of that nature, we usually will recommend the porting of the mortgage because you get to take your exact rate for the exact terms to the next property, as long as you buy the next one within typically 90 days. Some lenders will go up to 120, but 90 days is the most common threshold. So you notarize the sale of one, you got 90 days to bring it to the next one, and then you just get a second mortgage on that new property. So you get two tranches effectively. So you have one, let's say at 2.5%, and then you have another for the balance of the mortgage at your current rate of, let's say, 4.5% or 5%. And now you have this blended rate combination of the two for the duration. You can time them up to end at the same time and then just redo one refinance together at that point. Or you can take one for, let's say you had 2 years left plus 5 years left on the new one, and you keep going with blended rates for the next little while.
That's so cool. I didn't know that was an option. I kept hearing from people on like groups on Facebook and stuff being like, I feel trapped in my house because I have this crazy 2.79% interest rate and I feel like I can't move or sell my property because I'm going to be hit with a huge interest rate.
Nobody's trapped. So obviously it depends. And this is, again, when you're looking to, you have to keep the value of the property the same or equal. So the mortgage has to be at least the same or equal. So there are restrictions, obviously. It's not just no problem, whatever. But if you are looking to upgrade your home, if you are looking to move, make a lateral move, this is an excellent option available to you. Allows you to not get hit with penalties. Buyer beware, you will pay the penalty at the time of the notary sale because the banks want to make sure that they have it. And so long as you buy that next property within that 90-day period, then they're going to refund you that penalty because the bank always wants to collect up front in case you don't buy another property after, and then they'll refund you after the fact when you have closed on that new property.
And lastly, a lot of people think that they can't negotiate with their lenders, but you can negotiate with your lender, so it's worth a call. You got nothing to lose. The other thing that you have to actually watch out for are the additional costs. So if you break your mortgage and you decide to go from one lender to another, more than likely you're going to be confronted with new notary costs. Maybe another appraisal, maybe some administrative charges. So you have to factor those costs into wanting to break your mortgage. And then you really have to ask yourself, is it really worth breaking my mortgage? And again, I come back to the same thing. If you've only got 18 to 12 to 6 months left, then write it out, because those additional costs will wipe out any savings that you may find by going from one rate to another.
To add some light onto those costs, the appraisal is typically going to be somewhere between $300 to $500. The notary fees associated are usually about $900 to $1,000. So you can very quickly be at almost $1,500 without talking about the bank penalties, right? And the lowest penalties I've seen lately are typically about $3,500. That's assuming a very normal mortgage. And then obviously the sky's the limit. I've seen them go to $30,000, $40,000, $50,000. So.
And lastly, and a lot of people don't think about this, so if you sign a mortgage, let's say at 175 during COVID, and all of a sudden you're confronted with a 4.5 or a 5 or whatever it may be, you need to requalify. Oof. And so if you qualified under different circumstances, and you decide to break your mortgage, remember you need to requalify. So make sure you crunch the numbers and make sure before you break your mortgage and before you take that step that you'll be able to get another mortgage and requalify. And remember, it's not only the interest rate, it's the stress test, which adds another 2 on top of it. So you can have to requalify somewhere in the 6 range or even just under 7 range. So make sure you've got the means to requalify, because then you could be, up that creek.
Coming up after the news, we're going to talk about some of the pros and cons associated with multi-generational living. If you need advice on that sort of thing, give LJ Aguinaga a call. You can call him at 514-500-4040.
Under One Roof MTL, hosted by Robin Flynn, featuring mortgage brokers Fred and Martin and real estate expert LJ Aguinaga. Presented by Fred and Martin Mortgages and LJ Realties.
This is Under One Roof on CJAD 800. I'm Robin Flynn. That's LJ Aguinaga. And that is Martin Spalding. We are with you until 1 p.m. Ooh, multi-generational living. This is becoming more and more common. And now that I have a child, potentially more at some point, having my dad nearby is the absolute very best thing. If I could move him into my house, I would 100%. He probably wants his own space. He wants to be able to do his own thing. But I have a lot of friends who are getting their parents to move in, but not in the old traditional way.
I've got a stat, actually.
You've got a what now?
I've got a stat.
Do you?
Well,
I love stats.
Everyone teases me because of my show prep, but I've got a stat.
I love it. I love it.
Before, because I know that LJ is going to lead this story.
Yes.
But multi-generational households have increased by 45%
wow.
in the past 2 decades.
That's incredible.
And there are over 1 million homes in Canada that are considered multi-generational homes today.
Now, when I was a kid, multi-generational homes were usually grandma lives with us. Like grandma had a room in the basement or something, but she was part of that family unit. She lived in your dwelling with you. Whereas now we're seeing like the in-law suite. You get your own kitchen, bathroom, bedroom, living room. This is becoming more and more common. LJ, is this a way to cut back on costs? Is this a way to help with childcare with more two working parents? Why are we seeing this increase?
I think there's a lot of reasons, and let's start going kind of one by one. I think that for many, many years and in a lot of different cultures, living all together in the family home was historically and what is still today common practice, at least until you get married, especially in Latin America and different parts of Asia. That's still what we're seeing every single day. And I think in North America, we had a lot of that, especially with the original immigration that we had in the, let's say, mid-1900s to late 1900s. And then as time kind of progressed, people wanted a bit more independence and more of what we thought was the American way, if you will. And people wanted to kind of go out on their own and do their own things, and off we went. And I think that in the last 5 years, specifically for a combination of reasons, I think COVID, first of all, played a huge role in that. I think a lot of people were very lonely, obviously. And especially when we had a lot of the restrictions that stated you could be your family unit, and as long as you were in the same household together, you were allowed to do more activities together. That obviously started encouraging a certain trend in that direction. Then we have costs with inflation and just the cost of housing that's up almost 47% in the last 5 years. That's going to play a huge role and variable to people. And I think that people are kind of got reminded along the way that, hey, it was really nice to have family close by and to have help with kids and obviously 2 working parents. I mean, even my wife yesterday said, hey, would you consider moving back to Laval so we could be closer to my parents? And these are conversations that are coming up more and more.
What was the answer?
We said we'd talk about it later in the week. I asked a couple of times, are you sure this is what you want to do, or is this this week thing? So, yeah, you're hearing more and more of it. So I think it comes down to several different reasons. All of these factors are playing a role in people's decision making, and obviously it's leading to more and more of this happening every single day. And as you mentioned, there are different ways of seeing this now. We have the duplexes, we have the triplexes, right? So we can buy a property that already has 2 different types of units separated, or even a home with a bachelor in the basement.
Yep.
And have that kind of separation, but still the intimacy. I mean, I've told a couple clients this year who bought a house that had the space at least for an in-law suite, if you will, and they're converting the whole basement into kitchen, bathroom, everything, in Chateauguay even.
I have a question. So a lot of people in the early aughts, so early 2000s, were adding income properties to their homes as a way to offset their mortgage costs, right? I feel like that became so common. I saw everybody renovating their basements to turn them into apartments. Is this sort of how we're using that space now. We had created all of these income properties. People decided, I want to rent a basement in somebody's house. And now we're housing our parents and our sisters in them.
I think it kind of started, to be honest, there was a huge push for even just creating a space in the basement for your teenage kids.
Yes.
Right? I remember when we were growing up, and I even saw a meme about this in kind of the mid aughts, as you mentioned, we'd always hang out in basements. You know, it was a house party. It was in the basement. That's where, and then all of a sudden, people would make bedrooms and bathrooms and even like a little kitchen suite, if you will. And we saw more and more of this. And then obviously we're now talking about, we have to do something with it. So if we have an exterior entrance, even or a side door, so that you wouldn't wake up your parents when you got home at 2, 3 in the morning.
Yep.
All the better. And now it's going full circle to obviously bring your parents back into that space now, and you using the larger living space upstairs. So for sure.
What about permits? Do you need permits when I just heard Robin say, we've got a basement, we want to turn it into an apartment, we want to be able to rent it out, or we've got a basement apartment that we want to actually put my grandparents in. Where do the permits start to come in? Because I've heard some horror stories of people converting basements into rentable apartments without permits. And then the city comes by and says, where's your permit? And they say, we didn't have a permit. We didn't know we needed a permit. And the city says, put it back like it was.
So the simple answer is you need a permit for just about everything. And even if the city says, you don't need a permit for that, you're better off to have gone and asked about the permits in order to make sure you're not doing anything that you shouldn't be doing or is deemed to be illegal. There are a lot of neighborhoods that do not allow intergenerational homes. And it sounds crazy. And there are certain streets and parts of because the bylaws state that you can't have 2 units on one lot, where it's like, oh no, it is illegal to have an intergenerational home. Now, what determines one is an intergenerational versus not having access in the interior. So you could have a separate entrance on the right side, and you can have kind of a whole kitchen and everything down there, and that could be totally legal, because you even had a lot of families who wanted to keep 2 kitchens, one for actual prep, one for show. But as long as there's an opening on the interior between them, then that's just part of one single family home. If it is blocked off and you can't actually connect them, now we have 2 separate distinct units. Now we have an intergenerational conversation where you really want to make sure that it is allowed by your municipality.
Does it have to be a family member for it to be considered an intergenerational unit?
I guess now we're getting to verbiage.
Okay.
Right? So I think in verbiage, we usually consider it intergenerational when it's because we're talking generations of a family, right? But realistically, once you have 2 units on it, it should fall under the duplex category in terms of listing it. However, you're right. When we're listing it online, it's kind of what it looks like almost is what's going to determine is it an intergenerational or a duplex.
Now, there's a new tax credit. Right, Martin, for multi-generational home renovation. Well, you're the one that has all the notes, so I assume you've got info on this, right? So if you want to add an intergenerational unit to your home, there is a tax credit for that. The Canadian government wants you to do this because obviously there's a housing shortage, and they think, great, if we can double up in one single home, that'll be good for everybody, right?
There is. So it's called the Multi-Generational Home Renovation Tax Credit.
How unique.
That was a mouthful. And basically what it says, eligible individuals can claim 15% of qualifying renovation expenses up to a maximum of $50,000. This translates to a potential tax credit of up to $7,500. Eligible criteria. The renovations must be completed in the tax year for which the claim is made. The secondary unit should be intended for qualifying individuals, and the claimant must be an eligible individual, says a family member who owns the home. Okay. So there are programs out there, and this is all just to motivate people to get into their homes or stay into homes and get out of rentals and into buying properties that maybe on their own could not afford on their own, or looking to save on expenses, from sharing the heating costs, the electrical costs, or even having a built-in babysitting service. So if mom and pa are living in the basement and you've got 2 young children and you and your husband are working, it's nice to know that mom and pa are downstairs.
You can also save on streaming services because they've cracked down on password sharing if you're on separate internet networks. But if you have an intergenerational unit, you guys can use one Netflix account, one Crave account, one Disney Plus account. So you save quite a bit of money because those streaming accounts, they add
up quick.
Oh, yes.
But it comes back to the same thing, that when you're getting into the real estate market, and I'm looking at LJ, there are so many programs now that are out there. Do your homework. Or speak to people who have done the homework. Because it's expensive enough to get into that property that if you can use programs to give you a leg up, why not use them? But educate yourself, because it will be the biggest investment you'll ever make in your life.
LJ, are people coming to you asking you to find them multi-generational properties?
We have a couple clients, 100%, who exactly, young family, now has 2 kids under the age of 5, would love to have grandma, grandpa living with them, obviously, and then we've done it a couple times this year.
Very cool. If you're looking for a multi-generational home, you can give LJ a call at 514-500-4040. And if you want to know more about that tax credit or any other sorts of programs that are available to you, call Martin, fredandmartin.com. So easy to reach you guys.
Yeah, no, I'm building a binder and all this stuff. So
a binder? Ooh.
I'm becoming a binder guy.
It's going to be color-coded, I bet, with tabs and things highlighted.
Right. You guys have fun making fun of me, but call me because I will have the information for you.
Guys, you should have seen my binder when I got married. It was color-coded. I created a spreadsheet. I share it with everyone I know now when they're getting married. I'm very organized.
Under One Roof MTL, hosted by Robin Flynn, featuring mortgage brokers Fred and Martin and real estate expert LJ Aguinaga. Presented by Fred and Martin Mortgages and LJ Realties.
This is Under One Roof MTL on CJD 800. I'm Robin Flynn with LJ Aguinaga and Martin Spalding of LJ Realties and Fred and Martin Mortgages. Fred should be back next week, right?
Absolutely.
I miss him.
Yeah, so do I.
Our godfather of mortgages. I bet you do, for sure. Guys, it's time for my favorite part of the show, our property of the week. LJ, what do you got for us?
Are you looking for one of the most affordable condos in the city? Welcome to Le Vial, located at 5720 Chemin Upper Lachine, apartment 117. The sunny 1-bedroom, 1-bathroom gem features a spacious kitchen, a bright living room with large windows, and your own private balcony. Enjoy the building's rooftop terrace and gym. This unit is a quick walk to the Vendôme metro station, restaurants, and more. Listed at just $275,000. I did just see your jaw drop, Robin.
Wow.
With all appliances included. Don't miss this chance to invest or settle in style. For more details, visit our website today, ljrealties.com. And now your favorite part of the segment. Go to my favorite restaurant in the area would have to be Villa du Souvlaki. I've been going there since I was in college.
Absolutely. I love it there.
Order the gyro pita with a side of fries and tzatziki, and you will not regret it.
I used to live on the corner of Upper Lachine and Giroward, so I know that neighborhood super, super well. The former Mamessos, a moment of silence for Mamessos, loved a good sub from there. But $275,000 for a condo in NDG? Mm-hmm. Especially they're about to reconfigure De Carry, De Maisonneuve, that kind of mess of an intersection, the 5-way intersection, which shouldn't exist. Once that's reconfigured, I feel like property values are going to go up.
Super hospital, literally just down the road, Vendôme metro station. I mean, there's so many pros about this location and unit. Don't miss
night bus on Sherbrooke, so you can get home from downtown late at night after the metro closes. Can you tell I used to live there when I was in my early 20s?
But let's talk more about Villa du Souvlaki.
Please. I love that you guys all knew about it.
Of course. I literally lived there.
It
So
literally is by far the best.
So good. So good. It's all about the tzatziki. What you
Shout
do with
out Villa.
Very nice. Guys, our trivia question of the week, nobody got it.
Is that the first time this ever happens?
This is the first time it's ever happened that we stumped them.
Are we doing Jeopardy style? Closest to the answer without going over?
Yeah, exactly. Our question this week brought to you by Felix and Norton Cookies. In Quebec, what is the standard time frame for a buyer to fulfill all conditions after an accepted offer on a property? To be fair, it's kind of a trick question because there are multiple offer scenarios, but LJ, what is sort of the standard at LJ Realties?
Our standard on a standard residential transaction, if you will, would be 15 days. We ask for 15 days for mortgage approval. We'll ask for 10 days to do the inspection, plus 4 days to review the inspection report. And then we'll typically ask for documentation within 5 days, with an additional 7 days to review. So the latest delay is what we usually go by because that's the end of it. So that would be the 15 days for the mortgage.
So since no one got it, does that mean we get the cookies? We stumped the listeners.
Are we double down next week?
A double batch of cookies. Ooh, double or nothing, guys.
Okay.
We'll have to make it really hard next week now. Guys, we learned a lot this week. At least I did. I always learn a lot when I'm here. Variable and fixed rate mortgages are two very different products, and you definitely have to weigh your options when you decide which one is best for you. Read those conditions. Read the fine print. Understand what it is that you're signing.
And what you're comfortable with as well.
Absolutely. Understand your mortgage penalties. Ask your mortgage broker or your lender to explain them to you before you sign.
Penalties and other costs.
Penalties and other costs. What was that new term that I learned today from you? You're going to port your mortgage?
Porting your mortgage, yeah.
Yeah, that's really cool.
Port or blend
your mortgage if you want to leave a property and go to another, which is...
That's to port it, and then to blend it is when you take a second mortgage or a second
Right.
tranche, and then you blend the two rates together for an average.
Very cool. Very cool. Also, we learned that multi-generational living could be a great option for pooling funds and resources to buy that home you've been dreaming of, or to get some free babysitting, which would be my case. I'm picking my mom up from the airport today to come help out with my daughter this week. So,
But you got to be comfortable with family dynamics. You
Yeah.
got to be comfortable having your mother-in-law telling you how to raise your children.
I don't know that very many people would be okay with that.
But going in, you got to know, right?
Yeah, I think in our case, for example, my dad could for sure. He's really good friends with my husband. They have a lot in common. They love sports. They love photography. They hang out all the time without me, and they have a blast. So I think they would be cool.
But just know that family members share their opinions.
It's true.
And you got to be comfortable with another person's opinion.
It's intimate living with somebody.
Yeah, close
Very
quarters.
intimate.
Yeah.
Very, very intimate. Guys, we're almost out of time here. We didn't have time to get to one story, though, that I definitely wanted to mention before we wrap up. We've got a couple of minutes, so if it's okay, I'm going to bring back this topic that we didn't get to a little bit earlier. If you rent out a property on Airbnb and other short-term rental sites, be prepared to pay a hefty new tax. And I wanted to get this in because it's a big news story, and I saw people talking about it on the Under One Roof Instagram page, so I want to make sure we squeeze it in. If you eventually sell your property, that's when this tax is going to kick in, right?
Yes, exactly. And this is, I mean, they're talking about it as a new tax because now they're going to be cracking down on it. But anybody who's had a CITQ permit, which is what you're required to run a commercial short-term business in Quebec at least, this has always been the case. I mean, this is a property that you're doing commercial activities under. You're going to have to pay GST, PST in Quebec, so the 15 or closer to 15%. I guess the rest of Canada is waking up to this effect and making that part of it. Now, again, if you use it as a principal residence and you rent out your property one weekend of the month, that's going to be allowed. But it really comes down to if you're bought a property to rent out as a short-term investment, which we see in, let's say, Tremblant all the time or in other resort areas like that, then 100% commercial activity, that's GST, PST, sales tax.
Yeah, because short-term rentals are considered very similar to a property that is being used as a hotel, motel, or an inn. So it falls under the same sort of definition. So it's no longer a residential property. It becomes a commercial property. And hence, when you sell it, you're impacted by the tax.
But if you're somebody who lives there all year round and you go to Jamaica for 2 weeks on vacation and you decide to rent it out while you're gone, you're fine.
Depends how bad they want to crack down on it. I guess they could technically come down and say, well, 2 weeks out of the year, what's 2 on 52? Realistically, I don't see that happening. But again, CRA reserves the right, and we all bow down to CRA, so I will not step on their toes.
It's always a cash grab. You got to know if there's money to be had, they're going to come after it. So
Absolutely. Remember that story about that landlord who skipped the country and left his tenant with the tax bill?
Apparently, they let him off. I've heard that they ended up saying, okay, we're not going to charge you. You're right. This is ridiculous. But I haven't seen it in writing.
Oh, wow.
well, maybe there's a follow-up there.
Well, I think we should do a
Yeah,
follow-up.
no,
That was our
absolutely.
most viewed video on TikTok of all time, was us talking about that story. So that's a little teaser for next week. Okay, let's make sure we get in all of the contact information. By the way, Under One Roof can be heard every Sunday live at noon right here on CJAD 800. You can check out the website, underoneroofmtl.com, and direct all of your mortgage and real estate questions to us. In the meantime, you can reach out to LJ, Fred, and Martin individually. Martin, how do people get in touch with you?
Very simple. FredMartin.com.
FredMartin.com.
FredMartin.com. Very simple. All our information is on the website. So just go to FredMartin.com.
Perfect. Little switcheroo on you there. LJ's like, I'm usually first. What just happened? LJ, how do people get in touch with you?
You can check out our website, ljrealties.com. That's LJREALTIES.com. Or on all socials with the handle LJ Aguinaga. That's LJAGUINAGA. Or you can also check out our socials for LJ Realties with that handle. Feel free to call or text me anytime, 514-500-4040. I love hearing from you, and we've actually started to get a few people reaching out about different projects, so I want to hear from more of you.
Amazing. If you missed anything, you can hear the show in its entirety on iHeartRadio, Spotify, Apple, or wherever you get your podcasts.
And Fred is back next week.
Fred is back next week. All hail the Mortgage King. For LJ, Fred, and Martin, I'm Robin. This has been Under One Roof MTL.